I have the authority from the organizers to start this session. May I once again request you to now, we are starting to pay attention. We are starting this session, and I think you can put your mobile phones on again in 1 hour and 15 minutes. Okay. So what is this session? Financial, I have to look again to see what it is about. Financial stability and regulatory architecture. Good. We have 3 eminent people here, sorry. But before I give the floor in the order in which the program lists them, just a few thoughts. You know, I remember G20 once a year when ICRIER does this G20 conference. And then they get in touch with me saying, you know, would you like to chair one of these sessions and so on and so forth. So that's when G20 again obtrudes into my consciousness. Otherwise, I'm living a happy, quiet life. But now that G20 has come to life once again, you are all aware that in Chengdu, it's a delightful place where I bought very expensive green tea without realizing how expensive it was. At the airport there, which has got 25 bays or something like that, in terms of how developed the airport is. I didn't get beyond the airport. Chengdu is where the finance ministers and the governors of the central banks of the G20 countries, if I remember right, met somewhere around 23rd, 24th of July of this year. And the summit is, 3 weeks, a little more than 3 weeks away, 3rd, 4th, something like that, 4th, 5th of September. So this is the time for our panelists and the people here to make your recommendations. And I'm sure ICRIER will duly pass them on to the heads of government and state to take note of. But now, with those words, let me just say that, you know, I have one senior colleague in government who used to say, and perhaps with some justification, that when it comes to human values, when it comes to sympathy and feeling for fellow man, then it is multilateral forums. When it comes to vital national interests, then it's all bilateral. So, well, I don't know where G20 falls, because it's not World Bank, IMF, or the UN. It's somewhere in between. It's somewhere in between bilateral and multilateral in the true sense of the term. I don't know where we are. I mean, you know, we've already heard so much since the morning about negative interest rates and so on and so forth. We've heard of, Professor Verma says that we already had a Plaza Accord, not the Hotel Plaza in New York, but in Shanghai and so on and so forth. We can keep discussing and arguing about this. Do we have rating agencies which can be trusted? Do we have already some mechanisms? I mean, it was called communism a little while ago, but the IMF does provide balance of payment support. And there are other mechanisms closer home, like the Chiang Mai initiative that China and Japan put together. Now, what I would submit to this group of eminent people when they talk about financial stability and regulatory architecture, if they could kind of embed it in a setting in which the G20 could make some meaningful contribution. How exactly would that happen? Taking into account the fact that when it really comes to vital national interests, it's at the most bilateral. It's usually, depending upon how large the sovereign is, it is decided nationally in the national capital by whoever are the leaders in whichever kind of political regime that they have. Now, there's all this talk about foreign exchange reserves and whether countries should build up huge buffers for the doomsday scenario. And there's also this talk about the SDR, and can SDR be the currency that countries stock up on rather than the US dollar or some other currency like the euro. I'm not sure whether it would work, given the fact that the SDR is not freely traded. There is this talk about taxes on illicit financial flows. There is the Addis tax initiative. You'll notice I'm picking on things which are not necessarily very important, but which have something to do with the multilateral setting and particularly the G20. I think I'll stop there because I'll have the opportunity to comment on what the speakers talk about and hand the floor now. I have a few other points, but I'll build them into comments in between the speakers and so on. So at this point of time, Ashima, I'd like you to make your presentation either from here or there as you find convenient.
Thank you, Chairman, and thank you, ICRIER, for the invitation and for keeping this discussion going so regularly, which is quite an effort. I thought one of the things I learned from the morning panels was that this assessment of G20's contribution, that the core economic and social agenda, not much G20 has disappointed because we are seeing the world globe continues to be fragile. So this is what I'm going to focus on in this presentation, that G20 was set up to address a global financial meltdown, and yet financial risks continue. And some of these have risen because of weaknesses in financial reforms. And there was a lot of academic discussion which suggested more broad-based reforms in different kinds. And there was experience, I will argue, in some countries with this kind of reforms, but a refusal to learn from diversity, I think. So we are seeing continuing risks. For example, oil shocks, the volatility in oil prices are directly responsible for a reduction in global trade and global growth. I'm going to argue that there is simple macroprudential regulations. In fact, my take on the earlier session was that all this talk about macroeconomic coordination, the literature suggests there's not very much you can do. If something is in nation's benefit, it will be done. So so there is not very much to be gained from macroeconomic policy coordination. The coordination actually should be between macroeconomic policy, say QE, which is the main kind of unusual, unconventional policy, and macroprudential regulation. That is where there are positive benefits for all nations, but there are silos in thinking, I think, which prevent this kind of coordination from taking place. So to quickly go over we've seen a lot of reform after this crisis, but in some respects it was too strong, a focus on capital buffers, capital adequacy, which made it very bank-focused, which meant that there were exemptions, and which led to the rise of shadow banks. And for macroprudential, systemic risk was handed to stability councils where you had to coordinate, again, something which takes a lot of time, which builds in delays. And the buffers were too strong, and because it's impossible to build it up, there are delays. They still haven't reached the recommendations which are supposed to come in by 2018. But in Europe, for example, there are problems with banks, so capital requirements on universal banks are being diluted. Academic literature has suggested something like for a buffer to be adequate to prevent risk, you need to hold 20 units of equity for 100 units of assets, which implies only 5 times leverage is possible. But when Lehman Brothers, Bear Stearns fell, they had 33% leverage. And the Basel III total leverage ratio is trying to restrict this, but it allows 33 times leverage. So the restriction on risk-taking is absolutely inadequate. Moreover, some of the arbitrage we've seen is that hedge funds have really developed in this time, mutual funds and so on, because that's the arbitrage, that's the shadow banking. If banks are going to be handicapped by very tight regulation, then other types of funds develop. And these are agents, not intermediaries like banks. So therefore, capital adequacy is not adequate for them. So you need another kind of regulation. The US, the focus is on consumer protection and microprudential regulation, case by case, institution by institution basis, not overall. And the focus is on systematically large institutions, not which pose a risk, but not on overall systemic spillovers. And as a result, we've seen mutual funds, global assets under management rose from 50 trillion in 04, before the GFC, to 76 trillion, and now account for 40% of global assets. And in China also, shadow banking is 0.75 times GDP, while in the US it's 1.5. China is more worrying because it's grown very rapidly in the recent period. Now, there are some belated regulatory responses to these gaps, which should have been foreseen when the original reforms were designed. FSB has talked of implementing regulatory haircuts for non-bank to non-bank transactions, which would, but this is sort of again moderated in many ways so as not to upset markets, to exempt government bonds, and so as not to affect government borrowing and so on. And haircuts, the literature suggests, can aggravate cycles because you can trigger fire sales if your collateral becomes less value just when things are going bad. So they've suggested it should be calculated over the cycle and so on. Then the BIS is imposing more restrictions, capital requirements for banks for investment in equity in mutual funds. But even these are... they would tend, so there are some regulatory responses. They would reduce banks' exposures to mutual funds. And there are also, the argument is that this leverage, mutual funds can undertake leverage, but this is not well measured. And there are no leverage caps, for example, on hedge funds. And simple leverage caps are actually easy to apply universally and would reduce the leverage of systemic financial institutions. The other problem, apart from arbitrage, the global risk today is that of liquidity, worries about adequacy of financial liquidity, because regulatory tightening falling more on banks has also reduced their market-making ability. There are fears of funding risk if the markets freeze, bond markets go haywire as the Fed raises interest rates. But there are also arguments that the change in central bank intervention, when they're now borrowing risky assets and creating a market there as part of QE, has reduced risk spreads and risk-taking, which may prevent fire sales of assets. So therefore, this risk might not materialize. And there are arguments that central banks should also lend to mutual funds, since they might be the source of risk now. But in that case, this will lead to a kind of dependence on a drug from the central bank. There are also proposed limits on illiquid investments in ETFs, for example, and open-ended MFs where values can fluctuate. But in general, the mitigants existing are designed to protect investors, not for systemic effects on the system as a whole. And the regulatory changes focus on better data and information to regulators, which would feed into financial councils, stress tests. But all this, the regulatory reaction is very often delayed and ex post. So why not create better ex ante incentives? There's still not enough happening on that. And some of the effects, as I suggested, of high liquidity without leverage restrictions, without the kind of direct leverage caps that would restrict risk-taking and asset bubbles, has been the kind of bubbles we've seen in oil prices. And this is not all due to Chinese demand, because Chinese growth slowed much before oil prices fell. And there are other things, commodity futures, there is some research which shows that these bubbles were more in countries with lax margin requirements and position limits. Macroprudential regulations are designed for systemic risk. They recognize that this happens due to behavioral aberrations, where individuals do not factor in their effect on the system as a whole, not just due to large institutions that anyway have systemic effects. So they create better incentives for market participants, at the same time reducing regulatory discretion. And therefore, they're compatible with the development of markets. They reduce pro-cyclical expansion of balance sheets. And there is an interesting academic literature developing on this. Woodford, for example, has argued that there have been a lot of negatives from emerging markets on QE. He suggested the demand stimulus from QE would not add to financial risk if it was accompanied by macroprudential regulations. So examples of such regulations are lender-based position limits, leverage caps, taxes. They are simple and so can be universal. And this is where G20 can make a major contribution. For example, the success in BEPS. You cannot agree on domestic policy where domestic constituents are involved, but you can agree on norms, on standards for various kinds of limits, position limits, and so on. Much easier to get agreement, I think. So these, and moreover, these reduce risk taking without forcing banks, for example, to hold too much risk as if they have to hold huge capital buffers. So they would improve financial stability, yet protect financial innovation. Now, the implementation, there has been some talk, as I said, financial stability councils have been charged with these kind of regulations. But the FSP themselves remarked that they have been neglected. There are rules in Europe, but they're not implemented. Moreover, they tend to be borrower-based, where your credit you can take as a borrower is linked to your loan-to-value ratio, etc. But lender-based leverage caps are not used too much. And Claessens, for example, in an IMF paper has shown that EMs, emerging markets, use more macroprudential tools, 4 times more intensively compared to advanced economies before the GFC. And after the GFC, 3.3 times as the advanced economies have caught up somewhat. And they also found, researchers found that prudential measures are more effective in reducing leverage compared to buffers, even for banks, although Basel III and the financial regulations are focused on banks. Now, just as an example, I will illustrate how these kind of policies were used in India, and they reduced volatility. They were based on sectoral provisioning when real estate prices rose. They were conservative accounting standards which provided for losses while ignoring gains. All of this was counter-cyclical, exposure limits for selected sectors. And this allowed steady market development, yet the Indian financial sector was not contaminated by the global financial crisis. Now, today, what are the effects of these kind of leverage caps? Today, although the Basel III total equity requirement is 3%, RBI imposes 4.5%, which is higher. But the leverage, which would allow a leverage of 22:1. But in Indian banks, the leverage is only 10:1 even today. It's only 5:1 in PSBs, in public sector banks, against the 25:1 average in advanced economies today. And the reason for this is just these kind of ratios which are used, which reduce leverage. So they are very effective in reducing leverage. And buffers penalize emerging markets whose credit GDP ratio is low and has to rise with development. And they would actually, allowing a trade-off between capital buffers and these other kind of direct leverage caps would actually help, should be accepted globally, should be universally accepted, and would help all countries, not just emerging markets. When I say the strengths of Indian banking, it's also necessary to note weaknesses such as non-performing assets. But all this discussion should take a historical view, because these affect only PSBs who were pushed to provide investment to infrastructure firms during the boom around before the GFC. And there are problems. You need to improve the strength of their boards, accountability, etc., etc. But private banks concentrated on low-risk retail lending, and so they're doing better, which is a strength. It is a diversification of the banking system. But PSUs now are also shifting to retail lending. So who will lend to firms? I mean, so you need banks to be able to lend for development. So everybody's talking about NPAs in India today. The red line is Indian NPAs. We see that before the reforms, they were actually 12-14%, and they came down very steeply. NPAs in US banks, the dashed line is the US, were actually higher than in India just after the GFC. So the current rise is an aberration due to special reasons and will be absorbed. The best way to reduce, globally research shows debt falls when growth is high and interest rates are low. Indian interest rates have been high, growth is now rising, interest rates are falling, which should help improve the NPAs, apart from institutional strengthening and other reforms. Another thing one very often hears, again another example from India, is that controls don't work. They create distortions, evasion, and so on. But recently the IMF also has been talking about the use of capital controls to deal with capital flow surges. And Blanchard, in a recent paper, has argued that, an NBR paper, that actually this responding to Rajan's comments, Raghuram Rajan's comments, he is saying that macroeconomic policy coordination doesn't work, is not possible, will not contribute much to welfare. So advanced economy QE, which increases global demand, should be combined with capital controls in emerging markets to reduce the impact of capital flow surges. So you have but see, the problem here is that these are all the onus is being put on emerging markets, user-based, not lender-based. You also need lender-based macroprudential regulations. So one of the things said about India, one of the risks is on emerging markets generally, very high corporate debt rise in the recent period. But in India, we've had caps, graduated caps on debt inflows from abroad. And you see that India financial corporate debt is just 14% of GDP compared to 164% for China. So these are the kind of controls that have reduced risks in India. And also they reduced the taper on volatility, interest rate volatility. This graph shows that Korea, which is a developed market and has a higher share of foreign investors, the interest rate volatility was high. Indonesia, with a less developed market and very high share of foreign investors, 38%, was the highest at 17.4. While India, the volatility was only 1.3. And that was not necessary because of the market, but because of policy decision to raise rates. So a gradual development of domestic markets before you open out. So this is all the use of controls and macroprudential regulations. So these are graphs that show the volatility. And generally, many countries, there's a reversal of capital account liberalization, use of different kinds of tax-based controls. And so if you look at financial risk, there are credit risks where you need to control against borrower default, market risk, all this liquidity funding. But there's also regulatory risk, delays, and discretion. So there is a trade-off between incentives and insurance. So I'm being told to keep quiet. So, so yeah. So the idea is that capital buffers give too much risk to the financial sector market. The trade-off is inverse. There can be a better trade-off between incentives and insurance with macroprudential regulation. I think even in the financial centers, Brexit shows that the people are not satisfied with the way the financial reforms have gone. So more focus there on lender-based measures and use of macroprudential regulations. I think G20 has a major role in increasing the acceptance of such universal standards. Thank you.
Thank you, Professor Ashima Goel. That was very useful. We will, of course, discuss what you have said and what the other two speakers will say. I would recommend to everyone, just in case, I'm sure 99.9% of you have read from beginning to end the communique issued at the end of the meeting of the central bank governors and finance ministers, which took place in Chengdu. But I'll just read out one phrase or sort of one sentence from there. That communique takes note of the FSB's second, that is the Financial Stability Board's second annual report on implementation and effects of financial sector regulatory reforms. I don't know what it means. It took note of whatever has happened. And then the IMF, it also took note of this framework, this macroprudential framework that the IMF, FSB, and BIS are working on. I don't know whether I should be completely satisfied now that all this has been taken note of. But with those words, I hand the floor to Professor Verma. Please.
At the outset, let me thank ICRIER for inviting me for this. I'm not an economist. I'm purely a finance person. But this is a talk. Huh? Okay. So what I have done in this presentation, and it's remarkable that Ashima and I didn't coordinate at all, but we ended up with completely different things to talk about. So what I decided to do was to look at risks which we might have taken the eye off the ball. Post-2008, we have been focused on Lehman-style risks and trying to prevent other Lehmans from happening. And in the process, I believe we might have taken the eye off on certain other kinds of risks, and that's what I will talk about. The three big worries as I see it, number one I would put is the cyber threat to financial stability, which I think is inadequately appreciated. Over the next 3 to 5 years, I think this could become the number one threat to financial stability, and I want to talk about that. The other thing is that the whole set of regulations, all the stuff that Ashima talked about, as she mentioned, finance is being pushed into banks to shadow finance. But I think it's worse that it's moving even further to the dark alleys. And that is potentially a bigger source of risk. And finally, I think that resolution capability has actually declined. And those are the three things that I would talk about. The cyber threat. Cyber threats have been around for decades. But there is a huge difference in the last 3 to 5 years. One is that earlier, if you look at the target, it was people targeting your credit card, targeting your ATM, drawing $1,000 from here to $1,000 from there. From there, it has gone to the big stuff. I mean, when people say that SWIFT messages are hacked, then we're talking about something very different from hacking ATM machines. In the last year, we have seen 4 incidents about SWIFT. The most famous, which I'm sure we all know about, is Bangladesh Bank. Some $80-odd million stolen from there. There was another successful one in Ecuador. And that, incidentally, that came to light only when the Ecuador bank sued Wells Fargo saying that's your mistake. There have been 2 cases where it was unsuccessful because hacking took place, but the correspondent bank figured out that there was a problem. There was PT Bank in Vietnam, and in India, there was Union Bank of India. So 4 countries, this has happened. On the scale, $1,000, $1 million, now we're talking about $1 billion. There is this group, Carbanak Group, purportedly based in Russia. Over the last 5 years, they have stolen $1 billion from the world banking system. And they're still active. Today, there was a report that they have hacked into Oracle, and Oracle's payment system, the Micros payment system, 330,000 merchants around the world use Micros. They're all potentially compromised because they hacked it at the root. The nature has shifted. This was one, this is like, you find a cash box empty and you go and steal money. That's the opportunistic, casual kind of thing. Today, we're moving to something very different. I look at this, I wait 6 months, wait for my opportunity and go there. In the computer world, that's called an advanced persistent threat. You hack a computer, you get inside, and you stay there quietly for months, waiting for the right opportunity, increasing your presence and so on. So this is becoming very, very, very serious. And I think it's only going to go from bad to ugly. The reason is the cyber criminals are very well organized and are well coordinated. The dark market in which those tools of the trade are traded, it works very efficiently. So if somebody finds a way to hack into a computer, every other criminal gang in the world has access to the same tool because it is bought and sold in that market. On the other hand, if a bank finds a way to thwart a hacker, that knowledge does not spread through because the banks are not talking to each other. The banks are not even reporting to SWIFT that I had this problem. And the biggest fear that I have is that so far we have only seen the guys who want money. And those are the smaller threats. What about the guys who don't want money? Nation states, for example, which are driven by totally different things. I would worry less about a guy who wants to steal my $1 billion and go away. A nation like India can afford to lose $1 billion. But the guy who wants to say that I want to hack into your central depository and wipe everything clean. Now that's a much bigger threat. And that's the kind of threat which only nation states are interested in doing. And in India, I would think that we do have unfriendly neighbors. And some of them do have very serious cyber warfare capabilities. In fact, probably half the world today would have an unfriendly nation state with proven hacking capabilities. Okay? So we are all a threat with that kind of thing. And I think regulators need to think hard about this, that the idea that important databases sit only inside the banks, inside the depositories, inside the exchanges. No, important databases must go out public, sit on things like blockchain, which are very hard to hack. Blockchain can be hacked only if 50% of the nodes are hacked, and that's a much higher threshold than saying that I can hack X bank and I have rooted everything out. Okay. What's my worry on dark finance? What we have done progressively is to make life harder and harder for the guys, the core financial firms, and in the result, push people out from there. The roots of the problem is that it is a lot easier to monitor financial flows than to monitor what is happening physically. So you get the idea that let me monitor what is easy to monitor and let me use that to control everything. The result is that financial regulation today is doing a lot of things which have nothing to do with finance. Okay? You're trying to achieve some totally different objectives, and you think the easiest way to do that is via finance. And so you start putting in regulations to do that. It is hard for me to say which terrorist is getting hold of a gun. That's very hard to do, but I can try and keep track of how money is flowing to terrorists, and so I will go and do that. The result is that you get a whole burden of regulations which have nothing to do with this. This is a mission creep. Taxes, for example. You find it very hard to monitor what is happening in taxes, so you put the entire burden on the financial system. AML, CFT. India continues to use financial regulations to bolster capital controls. Yeah, I won't even talk about how we do vote bank politics with priority sector lending. But there's a whole lot of things which has nothing to do with the safety and prudence of the banks. It is extra financial things. The US uses financial regulations as an instrument of foreign policy. So I sanction a country and then I use the control of the entire banking system so that no money can go to Iran. It's got nothing to do with if the banks are sound, whether depositor money is safe. You're simply using that as an extension of your foreign policy. And we all know about the Lucas critique. You try to do that. The result is that people are going to change their behavior, and people are going to go out of mainstream finance into other intermediaries. And this is the fear that I have. The financial system, in my view, is gradually being repurposed from being an instrument of financial intermediation into an instrument of state policy. In a way, since 2008, the global banking system has been quasi-nationalized. It is no longer really about financial intermediation. It is an extended arm of the state, and you use state policy to do that. You look at the regulatory enforcements. How many regulatory enforcements that you have seen in the last few years are about somebody ran a bank in an unsound manner, versus how many were there where you've opened this bank account and didn't comply with that sanction requirement, or didn't comply with this AML requirement, or know your customer's customer, and all that kind of thing. And banks are becoming progressively unfriendly to the customer. The KYC norms becoming so hard that many people would say, look, why do I want to go to this bank when there is this informal system out there which doesn't ask for all of this, and it does the service equally fast, better, and much more simply. And therefore, I think we must not underestimate the risk that a lot of financial flows will go not just into the hedge funds and so on that you talked about, but even further out into the hawala markets, informal systems, and so on. And on the flight yesterday, I was reading this nice article in Regulation Asia that if things go like this, what will be left to regulate? That if financial flows move out of the regulated sector, then you have nothing to regulate. You have all these things, but they have become irrelevant. And over the next 3 to 5 years, I think there is a risk of this kind of thing happening. Let me just give you a couple of examples. Correspondent banking. Correspondent banking networks just collapsing. Why? Because the regulator says that if before you open a correspondent banking account with another bank, it's not enough that you have done due diligence on the bank. You need to know who those banks' customers are. This is the case, know your customers' customers. And if you're a bank and you say, how much money am I making out of this correspondent banking? Yeah, $50,000, $100,000. It's easier for me to close that. just shut down that and tell the bank that, no, you don't have this anymore. So Belize is the first country probably to be just cut off from the world because they have lost all their correspondent banking relationships. And Belize today, if you want to do business in Belize, the only currency that you can accept is Bitcoin because that's beyond the control of any government. Offshoring of finance in India, this has been happening. We tried to be too restrictive in India, so the markets move outside. Brexit was a fantastic example. On the day of Brexit, you had huge amount of trading in the futures exchange in Dubai and not really in India. So you try to regulate too much, it moves out of your control. And that's something that we need to worry about. And the third thing that I worry about is resolution capability. We have actually shut down the resolution capability that we had. India, I would say, never had serious resolution capability. Outside some partial ability to shut down banks, we never had a serious resolution capability. The last bank that we shut down was Palai Central Bank in 1962 or something. And even that, we don't really have. The US had reasonably good. Post Dodd-Frank, they have actually shut down that and basically said that you can't bail out anybody, you can't lend. If tomorrow CME needs $100 billion, the Fed can't lend it to them because the Dodd-Frank Act says you're not supposed to lend. Europe, again, the resolution system that has come in the last few years, I think is totally unworkable. And Italy is the best example where faced with the reality, it's not working. So in this respect, I think we are probably worse off than in 2008. 2008, you didn't have all these rules which are hamstringing the regulators. They could just go ahead. The Bernanke could just write out blank checks. And today, nobody can write out blank checks, which means that you can't resolve big institutions when they get into trouble. Those are the three big risks that I see. And the biggest worry is that, we are not, I don't think regulators are paying enough attention to these risks. They're dropping below the radar.
Thank you. Thank you, Professor Verma. You're bang on time. No, thank you. That was really interesting, complementing what Professor Ashima Goel had to say. Cyber security. I mean, wherever I go, I hear about cyber security. Whether it is a national security advisor and banking and so on. So it is a major issue, but what do you do? It's the price of progress. When I was growing up, there were no cell phones, there were no smartphones, there was no cyber security threat because there was no cyber capability. But that's life. Professor, we have to keep adjusting to new threats as technology keeps getting better. There are criminals, within inverted commas, who will try to take advantage of that technology. And you talked about shadow banking, and you've said that there are dangers beyond shadow banking. I can quite appreciate that. You referred to the fact that some states are using their clout to push things in the financial sector, and particularly with regard to banking, which is an extension of their foreign policy. That's not new. We can go back in time to see, for instance, the Russian ambassador in London told me that, he's finding it difficult to open an account because of the fact that there are all kinds of regulations when it comes to Russian nationals. This is the Russian ambassador in London. Then Sir Douglas Flint tells me perhaps he still is, the global chairman of Hong Kong Shanghai Bank. He told me that he worries. He spends sleepless nights worrying about what norm or what banking regulation their bank might have violated. And sure enough, that of course was in 2013, and now they have this, $600 or $800 million fine from the US regulatory authorities. Okay, so these are some of the issues that the G20 can grapple with, but I have a feeling it's far too granular at the level of summit meetings or even those at the level of finance ministers. I suppose these would have to be dealt with more by central bankers themselves in their meetings in Basel or elsewhere. With those words, now we've had two professors, one from the Indian Institute of Management in Ahmedabad and one from IGIDR, that's the RBI's think tank, or I would say university, whatever you want to call it. Now we have a practitioner. So they've talked about, he works for the Securities and Exchange Board of India. For those who don't know what is SEBI, I doubt very much that anybody here does not know. So over to you. Let's hear from SEBI as to what he thinks about capital markets and dangers and other issues that the G20 can tackle.
Thank you, Chair. And my presentation is rather on a narrower basis, I would say. So what I intend doing is, I went. My script is purely, driven by the title that was given, Financial Stability and Regulatory Architecture. So what I intend doing in the next few minutes is talk about the regulatory architecture that India has, and what is the infrastructure and the structure which has been created specially for dealing with financial stability issues, how that structure is working, what are the tools being used, how the systemic risk monitoring, let me at the outset say, as a securities market regulator, in fact, they're not supposed to do much with financial stability, but things have changed since the financial crisis, and even the global standards require securities market regulators to contribute to the management of systemic risk. So what has been the discourse in India, what have been the outcomes, and what are the quick takeaways, how this structure is working? So let me start with, just a word about, we all know this, we have in India a sectoral system of regulation. You have product-specific regulators. You have RBI, SEBI, IRDA for insurance, and PFRDA for the pension sector. In the past, the discussion has been that this kind of structure has been, I would say, criticized because one school of thought has been that it provides for regulatory arbitrage. There could be gaps and overlaps in regulation. And importantly, no single agency has a complete take on risks which are there in the market, complete view of risks, because everybody is looking at their own respective domains. So if you look at the Financial Stability and Development Council, the creation of FSDC in India was actually partly, meant to address those limitations that the sectoral system of regulation has. But let me also say that FSLRC has reviewed this architecture and they made their recommendations. So what are those recommendations? According to them, we should be moving into basically one consolidated, unified regulatory authority, which will have SEBI, IRDA, PFRDA, and you split certain functions out of RBI, and you create a separate public debt management agency and a financial resolution agency. Idea here is that for focusing on trading-related, products and markets, for focusing on consumer protection, you have UFA, and RBI looks at banking and monetary policy and so on. And you have a common appellate authority, like as of now, for securities market, we have Securities Appellate Tribunal, which looks at only securities market related issues. You create a FSAT, which is entire financial sector appellate tribunal, where all sorts of disputes would be referred to FSAT. By the way, FMC, the commodity market regulator, was merged into SEBI last year. It was driven, that was there on the card for a long time, and it was primarily driven by the crisis we had in the commodities market, that is the NSCL crisis. Now let me talk a little bit about FSDC. So basically FSDC was set up by the government as a apex forum in December 2010 through a government notification. It is not a statutory body, it doesn't have statutory powers. It has all the regulators are the members of FSDC, and its objective is to strengthen the institutional mechanisms for financial stability, inter-regulatory coordination, and financial sector development. Sometimes, there are debates around whether you can have developmental objectives along with stability objectives. But there are, pros and cons around that. So, just to give you a quick view on the FSDC structure, FSDC is chaired by the finance minister, and it has all the heads of regulators as its members, and the Department of Economic Affairs acts as the secretariat. FSDC subcommittee is chaired by RBI governor, and it again has representatives from all regulators, and RBI acts as secretariat. Then it has different technical and working groups. Technical groups are the kind of standing committees which look at different, for example, one group looks at, just to give you one example in the interest of time, Inter-Regulatory Forum for Monitoring Financial Conglomerates. So that's a standard, that's a standing kind of a committee, standing group which looks at it. There's a group for early warning signals. Then there are working groups also which are created from time to time with a specific mandate, and once they submit their report, that group is wound up. So that is broadly, so there is a sort of hierarchy around it. FSDC is at the apex, and FSDC subcommittee and the groups are sort of executive arms of the high-level FSDC. Now, FSDC, under FSDC subcommittee, financial stability report is brought out every 6 months, and we have a good number of those reports. And if you look at, the progress that has been made in terms of its coverage of the issues, and also in terms of the various tools which it deploys, it makes a pretty impressive reading. So here I've listed certain tools which are being used for dealing with financial stability issues in the country. There is a network analysis, stress testing of all sorts, then banking stability map and banking stability indicator. There's an MOU between regulators to facilitate the supervision of financial conglomerates. And there are coordination mechanisms through various groups which have been created. Regular meetings takes place, and also there's a systemic risk survey. In fact, a number of surveys have been done. And the idea here is to get the expert opinion from the industry as to what is their perception about the systemic risks which are there. In fact, in Germany, they have something called trend scouting, where they do a similar kind of survey, but the idea is to identify the trends which can foreshadow certain risks which are building in the system. So just to give you a sense of, I talked about network analysis. So network analysis is done in two parts. One is of the banking system as a whole, and one network analysis is done of the financial system, where if you look at this little complex, the networks which are shown in the first part of the chart, that shows that the mutual funds and insurance companies are the biggest fund providers in our system, and banks and NBFCs are the biggest receivers. And banks, mutual funds, and insurance together, they account for 80% of the cumulative assets of the financial system. And interestingly, the exposure of mutual funds and insurance towards banking is quite significant, I would say. It is 19% of the AUM of mutual funds is invested in banking segment. It is in absolute terms rupees 4.549 trillion rupees. Whereas the exposure of banking sector towards insurance and mutual fund sector is not very high. It is 176 billion Indian rupees. So the idea of showing this chart here is that there is a great degree of interconnectedness within the financial system. And if the stress develops in one part, it is bound to get reflected on the other side as well. So, so that's a short point. Now, as I said, what does SEBI have to do with systemic risk and the financial stability? We have an international organization of securities commissions, which gave two principles after the global financial crisis, which say that the securities market regulators also have to contribute to mitigation and management of systemic risks, and also they have to play a more active role in reviewing the perimeter of regulation. So we have set up, this is a very interesting experiment which we are doing within SEBI. We have set up something called Systemic Stability Unit, and which is trying to identify more and more indicators which can impact the, which can give us some sense of how the risks are building in the system where we can contribute. So here is the list of the data points which we've started tracking lately. For example, we track percentage of AUM of mutual funds invested in securities issued by banks. The previous slide also showed that. We look at concentration, what is the share of top 5 brokers in turnover. We are looking at the percentage of promoters' shares which are pledged. We are also looking at average monthly volatility, how the HFT turnover, high frequency turnover, the algo-driven turnover, how that is increasing, and also at the liquidity parameters. Now let me talk about what has been the discussion. What has been the discussion at FSDC? So very quickly, I think I'll just spend a minute on financial conglomerates. It is all listed here. The FSDC looks at global and domestic developments impinging on financial stability. All sorts of external developments, right from Brexit to US Fed rate hike, etc. The resolution regime, in fact, Professor Verma mentioned about that. Maybe during the discussion, I can throw some light on that. Cyber risk is very high on all the regulators' agenda. Let me assure you that. SEBI is very actively pursuing, we are doing two things. We are trying to build our capacity in this area as to how do you deal with this. And let me say that there's a huge problem of getting the right professionals to deal with these issues. We don't have the capabilities, but we are trying to build that. On the financial conglomerate, I would just like to say that the SEBI, RBI, and IRDA and all the regulators have entered into an MOU where they look at the criteria for identification of financial conglomerate. What is a financial conglomerate? Financial conglomerate is a company which has a significant presence in 2 or more segments of the financial sector. We have identified 11 financial conglomerates. 2 are under SEBI, and about I think 7 or 5 are with RBI. And of course, fintech and digital innovations. These are some of the items which are gaining attention. Inter-regulatory coordination, collective investment schemes is a success story. Because of FSDC deliberation, we could take some proactive preventive action, and we enhanced our regulatory perimeter. We got the SEBI Act amended, and some effective action could be taken. In the interest of time, I'll not go through all this, but on the extraterritorial, if you permit, I'll just spend a minute on that. Financial sector development issues. So finally, let me, in the interest of time, let me just come to my final slide. What is the message I'm trying to build through all these slides? This is my take. FSDC structure seems to be well embedded in the financial system now. It is established. A wide range of financial stability issues are discussed, and I think the range of issues has progressively improved. There are some tangible and timely outcomes, and most important, regulators are talking to each other through this structure. There's an improved coordination. Toolkit is expanding with greater use of quantitative techniques. And so this is the takeaway from what I try to build up through many slides. Thank you so much for your attention.
Thank you, Mr. Amarjit Singh. That was very useful. We have heard of various kinds of risks to financial stability, whether it is lack of adequate capital, cybersecurity, in terms of the regulatory structures we have in India, in terms of the coordination for regulation that we have in India. I think in the earlier sessions, there were other points that were made, which also are very relevant in terms of financial stability. When you look at negative interest rates for a very long period of time, it could lead to asset bubbles. I mean, there's not enough time to discuss every aspect of risk that the financial sector, both nationally and globally, face. And when you think of a venerable name like Deutsche Bank, which is trading at 50% of its book value, you worry. I mean, that obviously has some bearing on financial stability around the world, because it is a SIFI, it is a systemically important financial institution, given its global reach. But I'll stop there. I see there are a number of people in the hall, even so late in the afternoon, so I'm quite delighted to see that. So I'll stop talking now, and all I will request is, once we throw it open to the house, somebody will come around with a microphone, and if you could identify yourself and be as brief as possible, and if it is possible, if you could indicate to who in the panel you are directing your question. Okay. Please. With a show of hands, you can indicate, and I think it would be best if we take 3-4 questions, and then we'll have the answers from the panelists. Please go ahead.
Thank you. Just two brief questions to Mrs. Goyal. The first is the problem that we face. On the one hand, regulators want banks to become more crisis resistant. So they shall reduce lending to customers that are a bit problematic. But at the same time, the central banks want banks to lend more to some problematic customers in order to stimulate growth. Now, I'm somehow puzzled by this, because can you have it both? Can you have a stimulation of lending and make banks more crisis resistant? And then a bit of an exotic question. The IMF has dug up some years ago the so-called Fisher Plan of 1936, and in which Irving Fisher suggested that banks should have 100% reserve requirement. From an academic perspective, I find that quite entertaining and interesting. Perhaps you could, if you have a view on that, because you mentioned that a 20% capital coverage would already be quite a bit. So what about that Fisher Plan of 1936?
Let's get a few more questions.
Thank you. On a slightly different tack, Professor Farmer talked about decline in the resolution capacity for systemic banks. Perhaps you could say a bit more about that. My impression was that in a number of parts of the world, in particular in Europe, they're trying to boost resolution capacity at the same time as reducing the need for that resolution capacity ever to be used. Perhaps you could say a bit more about the relative importance of, on the one hand, reducing the risk that it's ever going to be triggered, and on the other hand, the need to build up those capabilities should the awful Lehman's type event ever happen again. Thank you.
Thank you, Chair. Actually, I have a general question. Basically, when you look at G20 as an organization, does the panel can they give an evaluation as to how effective the regulatory capabilities of G20 mechanisms have been in addressing the global crises that we are seeing one after another? And moreover, in terms or in times of, let's say, deepening crisis, as Professor Goel mentioned, how institutionally, how capable the G20 mechanisms are to devise the, as she said, ex-ante kind of mechanisms or ex-ante either institutions or policies which can actually help mitigate the impact of the crisis. So actually I'm looking for some kind of an evaluation of the institutional capabilities that G20 has acquired over these years. Thank you.
Okay, maybe the panelists can take a shot. I think some questions were addressed to you and some to you.
Thank you. I think this is an interesting issue that you want finance to grow, but you're worried about finance, about making it safer. So I think in India, the issue is that we are too much, we've historically always squeezed the private sector. Earlier, banks were used to fund the government. And now it is that our credit GDP ratios are on the lowest in the world, 50 to 75. Globally, normally it's always a rise in credit which leads to a boom or which aggravates a boom. Here, a rise in credit follows a boom. That's a stylized fact in India. So our regulators are very, very cautious, and they're over-cautious. And we have a number of ways in which we regulate this increase in credit. And therefore, although Basel III is a comply or explain, but internationally all these credit rating agencies will say you're not following these norms. So when higher buffers are being talked about, Basel is 3% for all assets, but we are imposing 4.5. We want to be extra cautious. If you'll see the kind of regulations our friend from SEBI was listing, they're all the international norms. While I'm arguing that earlier, prior to the crisis, we had followed macroprudential regulations